As we look back on 2025, the word that comes to mind for most investors is resilience. On paper, it was a fantastic year, but if you were watching the headlines day to day, it probably felt a lot more like a roller coaster. We saw plenty of highs, but we also had to navigate some steep drops that tested everybody's nerves. If we look at the big picture, global stocks performed exceptionally well. The MSCI World Index climbed 21%, with many markets finishing the year at all-time highs. But here's the interesting part. For the first time in a long while, the US wasn't the only star of the show. We saw international markets, specifically in Europe, Japan, and parts of Asia, outpace the US. A weaker dollar and more attractive prices overseas finally gave international investors the win they'd been hoping for. Closer to home, the US market showed us just how quickly things can turn around. You might remember that sharp pullback in the spring when the S&P 500 dropped nearly 19%. It felt like a crisis at the time, but the rebound was just as fast, ending the year up nearly 18%. And while AI and big tech kept the engine running, the real health of the market showed up in the later year. We finally saw returns spread out into sectors like financials, healthcare, industrials. It wasn't just a few tech giants anymore. It was a broad-based recovery. We also can't forget about bonds. As inflation finally cooled and central banks started cutting rates, high-quality bonds did exactly what they were supposed to do. They provided solid returns and the kind of steady income that we haven't seen in a decade. If 2025 taught us anything, it's that the market rarely moves in a straight line. But by staying disciplined, keeping a diversified portfolio, you weren't just surviving the volatility, you were positioned to profit from it. So here's to carrying that same discipline into 2026. So here's my 2026 market outlook. As we look ahead, the backdrop is very different from what we just experienced in 2025. Last year was strong, but markets are entering this year at much higher levels, and that naturally changes the risk-reward balance. One of the biggest themes heading into 2026 is valuation. U.S. equities, especially the large technology and AI-driven companies, are still priced very optimistically. A small group of stocks now makes up more than a third of the U.S. market, which means markets could become more volatile if leadership stumbles or earnings expectations cool. We're already seeing that AI enthusiasm alone may not be enough to drive returns the way it did before. At the same time, economic growth is slowing. It's not a recession call, but momentum is cooling, inflation is easing, and central banks are closer to the end of their rate cut cycles, which means policy support going forward may be more limited and uneven. That creates an environment where markets can move sideways or swing sharply rather than trend smoothly higher. We're also keeping a very close eye on the labor market. We've seen a steady decline in job openings and the unemployment rate has been ticking upward, reaching levels we haven't seen in 4 years. Now, to be clear, we aren't at recession levels yet. The economy is still growing, but the help wanted signs are coming down. Corporate America has shifted into a much more cautious hiring mode, and that's a single signal we just can't ignore. In Europe, international markets look more reasonably valued to us than the United States, while emerging markets offer long-term potential, but can be more sensitive to policy and growth surprises. Bonds are once again playing a more important role in your portfolios, offering income and diversification if volatility rises. This is why we're emphasizing a more vigilant approach right now. While 2025 is about capturing growth, the start of 2026 is about balance. Bonds are finally doing their job again, providing a safety net and steady income we just didn't have a few years ago. So looking at Luft Financial's portfolios, as we look at how markets are set up today, we felt it was important to take a more balanced and risk-aware approach within our portfolios that we manage for our clients. U.S. equity markets remain expensive, and returns are increasingly concentrated in just a small group of high beta stocks. At the same time, we're seeing signs of a softening labor market, ongoing geopolitical risks, and historically volatility tends to pick up during this U.S. midterm election years. None of this means markets can't move higher, but it does mean the downside risks are rising. So given that backdrop, we made a deliberate decision to take some profits and de-risk the portfolio rather than just chase returns late in the cycle. Within our Platinum Growth Fund, we reduced exposure to the 5 highest beta equity names, areas that tend to amplify gains and losses. We then reallocated the proceeds into the RBC Cube Market Neutral World Equity Strategy. This change helps us achieve several things at once. It lowers our overall U.S. equity exposure, it reduces our portfolio volatility, and adds a return stream that's less dependent and low correlation with the stock market. In periods of market stress or correction, market neutral strategies can help cushion the downside risk while still keeping us invested. So in our balanced growth model portfolios, we recently made a strategic adjustment by trimming select equity positions following 3 strong years of equity market performance. So with market volatility increasing, valuations becoming more stretched, we felt it was prudent to take some profits and reallocate toward more defensive areas of the portfolio. The proceeds were redeployed into our defensive sleeve, which includes long-term U.S. Treasuries, utilities, and gold bullion. Historically, these asset classes have tended to hold up better during periods of market correction. Long-term treasuries often benefit from falling interest rates and a flight to safety. Utilities provide stable earnings and lower volatility, and gold acts as a hedge against market stress and uncertainty. Together, these allocations help reduce overall portfolio volatility, provide stronger downside protection, and support more stable returns during uncertain market environments, while keeping your portfolio well positioned for the long term. Our goal isn't to capture every bit of upside. Instead of aiming for 120% of the upside of the markets and then getting 110% of the downside, we're intentionally positioning the portfolio to capture 85% of the upside, but only 75% of the downside. Over time, that discipline leads to a smoother return path and better risk-adjusted outcomes. This is about protecting your capital, managing your risk, staying aligned with your long-term objectives, especially in a more uncertain market environment.